The most important question while taking a mortgage is which rate should I take? Should I go for a fixed or a variable rate? In this video, I'll increase your understanding of how both types of mortgage function. A fixed rate mortgage and a variable rate mortgage, also known as an adjustable rate mortgage, are two different types of home loans with distinct characteristics. The primary difference between the two lies in how the interest rate on the loan is determined and how it behaves over time. Fixed rate mortgage. When you opt for a fixed rate mortgage, your lender sets an interest rate at the beginning of the loan term, and this rate remains the same over the life of the loan, regardless of any fluctuations in the broader economy or changes in the lending market. Predictable payments. Since the interest rate remains constant, your monthly mortgage payments stay stable and predictable, making it easier for you to budget and plan your finances. Long-term stability. Fixed rate mortgages are typically available starting from 1 year to 10-year terms. This stability is especially advantageous during times of rising interest rates, as borrowers with fixed rate mortgages won't be affected by the rate hikes. Less risk. Borrowers have less exposure to interest rate changes, which can provide peace of mind, especially during economic uncertainty. Let's try to understand this with a simple example. You went on to get a $200,000 mortgage from a bank on January 1, 2023, at a 5-year fixed rate of 4.70%. This rate of 4.70% will remain the same for you for the next 5 years and will have no impact on any rate change announced by the Bank of Canada during this term. Just to keep one thing in mind, during this term, if you decide to convert this fixed rate mortgage into a variable rate mortgage, the bank will charge you a prepayment penalty for breaking the term. A fixed rate mortgage is advantageous in a rising rate environment and can prove to be costly if the rates are on the decline. Variable rate mortgage, also known as adjustable rate mortgage. A variable rate mortgage, on the other hand, is a loan with an interest rate that can fluctuate periodically over the loan term. Here's how it works. A variable rate mortgage is typically available for a term of 5 years with most of the lenders. The interest rate adjusts at specific intervals due to fluctuations in the broader economy or changes in the lending market. The rate adjustments are typically based on the prime rate and are subject to a margin set by the lender. Uncertain payments. As the interest rate can change, your monthly mortgage payments may fluctuate as well. If the interest rate rises, your payments will increase, and vice versa if the rate falls. Different lenders have different rules for a variable rate mortgage. Some banks like TD Bank and RBC keep your payments the same even if the rate changes several times during the term of your mortgage, but instead, your total amortization period fluctuates during this time. Let's try to understand this with an example. You got a 5-year variable rate mortgage of $200,000 at 4%, with a contracted payment was $1,000 monthly starting January 1st. Assuming the Bank of Canada announced a rate increase on March 1st by 100 basis points, your rate also got increased to 5%. In this case, bank will keep your payment the same, but from the same payment, more will go towards interest and lesser towards your principal, which will increase your amortization. The point where your payments are not enough to cover the interest portion of your mortgage is called your mortgage having reached a trigger point. At this point, the bank will either ask you to increase your payments or will ask you to put a lump sum towards your principal. Risk and opportunity. Some lender like Bank of Nova Scotia offers adjusted rate mortgage and carry more risk, as borrowers may face higher payments if interest rates rise significantly. However, this can also be beneficial if interest rates decrease, resulting in lower monthly payments. Choosing between a fixed rate mortgage and a variable rate mortgage depends on your financial situation, risk tolerance, and market conditions. Fixed rate mortgages provide stability and predictability, while variable rate mortgages offer potential cost savings in decreasing rate environments but come with more uncertainty in the long run. An expert guidance is necessary before committing to any type of mortgage. Feel free to ask if you have any questions. Thank you.